Right, let's crack on. Jordi, you ready? Good, I think we have now a high number of people.
Yes, I'm ready.
Hello, and welcome back to the third session of the webinar, How to Master Due Diligence for Startups. This webinar is co-hosted by Nauta Capital and Metrics Partners. And your hosts today are myself, Borja Breña. I'm a principal at Nauta Capital, and Jordi Pedrol. Hi, Jordi.
Hi, everyone. Thanks for joining us.
Jordi is a partner at Metrics Partners, and very happy to have you here with us, Jordi.
Thank you so much.
Good. Well, you might be the first time that you join us, so maybe you've joined us in the previous two sessions of this webinar. Remember that this is a series of 3 sessions on how to master due diligence for startups. And we have organized these sessions in, focusing on 3 different aspects of the due diligence. The first session was about what to do before the due diligence. The second session was about what to do during the due diligence. And we'll speak about after the due diligence in this session. Just some takeaways from the previous sessions for the benefit of whomever wasn't present, but we definitely, we have put the video of the previous webinars on the blog of nautacapital.com. We have also created a post where we have the takeaways, and we also share these slides that we're going to present. So they are freely available on nautacapital.com website, and Metrics Partners, they will also share it in their channels eventually. But let's remind us in a couple of seconds on what we discussed in the previous 2 sessions. So the first one, before due diligence, the objective of this session was to discuss why preparing for due diligence is important. Basically, the most important takeaway is simple. It's a well-known comment: people buy from people they trust. Okay, fundraising is a sales process, so you need to gain the trust of those people who are buying from you. In this case, potential future investors who are buying the shares in your company. So how do you gain the trust? Well, planning and organization will allow you to gain this trust and close the round successfully, faster, and even perhaps raising your valuation. You need to keep your house tidy, you need to prepare in advance, and you need to have the ground ready for investors. This is the best way to gain their trust. Then in the second session, we were discussing what to do during a due diligence, when you already have investors interested in your company, but they are actually analyzing it in quite a lot of detail sometimes. The most important takeaway is also very simple. Take due diligence seriously. It will be worth it. It's a necessary pain. It's not sufficient, but it's a necessary pain to close your round, because you need to gain the trust of the investors. Success in due diligence is defined by your ability to negotiate and close the round, and your ability to run a robust, rigorous process. And by the way, this is contingent on having prepared previously. So remember to do your homework, and as part of your homework, read and watch these 3 free sessions. Right, so Jordi, what are we going to talk about in this session today?
Yes, well, you've closed the series. Congratulations. But now, the minute you close the round, you're fighting against the clock. It's a 18 to 24 ticking clock, because you have to get ready for the next round. So in today's session, we'll cover some of the main topics that you need to focus on to navigate successfully to the next round.
Excellent. Right. 1 minute, sorry, some credits on Nauta Capital and Metrics Partner. We promise to be short. You've heard us before. We invest Sonata Capital is a venture capital fund, pan-European. We invest in software companies. We invest usually in world-class heroes or teams of heroes. They're usually capital efficient, they're technology-based, and we usually put in between 1 and 5 million euros. And obviously we have plenty of capacity to follow on. We can go in a company as early as pre-revenue, as long as they have launched their product, and all the way up to when the company is at around 200K monthly recurring revenue. And Jordi, what about metrics?
Yes, for those who were not present in the previous webinars, we are an advisory firm that provides a fractional CFO and financial advisory services to tech startups. And we also work with investors such as Nauta on financial and business due diligence. Here you have a selected list of customers and investors.
Excellent. So let's dive in.
Let's start the webinar. Hopefully you enjoy it and you get some insights out of this. And so the outline of today's presentation, as we said before, you close the round, congratulations, but now it's when you're fighting against the clock. But against the clock, that is going to be 18 to 24 months, the time that you need to get ready to raise the next round. So the main topics that we think, or some of the key topics that you need to focus on to be successful in the next fundraising are the ones that we have shown here. First of all, you need to be fundable again the next 18 to 24 months. We'll see what that means. You have to execute the business plan. You have, You have to also scale your finance operations. Things will get more complex and demanding. And you also want to look for alternative, non-dilutive funding sources, right, to expand your runway and in the case of milestone achievement. So before we move to each of these topics, let's put in perspective that this is a very long and hard journey. Right? So very few companies will make it to the end. This is from the Atomicos, the State of European Tech 2020 report, and it shows you the percentage of startup companies that get seed funding that that make it to the next rounds. No? So these are a cohort of 1,064 seed-funded companies. Out of those companies, only 48% close Series A, only 25% close Series B, and so on and so forth. And at the end, just 1.2% get to the unicorn status. No, so that means that it's a very long, very hard journey, and just a few selected companies are going to make it. So we have to be aware of this, and definitely we need to increase our odds of going through this funnel and make it to the end. Just to mention also that according to this study, 77% of the companies that are seed funded will either go out of business or become self-sustaining. So the proportion of not making it is very high. And not all go out of business, some become self-sustaining, but at the end it will have to be an exit somewhere. Also, just to mention that these numbers are from European companies, startups, but in the US we have similar results. Next, please. At Metrics, we have worked with several companies that have made the journey from Series C to Series A, Series B. Just a couple of examples. One is on a Technologies. This is a knowledge integration platform that closed Series $27 million Series B in May last year, right? Less than a year after we closed the Series A, 11 million. Mentioned that ONA and the next one are both Nauta's portfolio companies. This is, by the way, a very hot startup and is catching a lot of attention from investors. And the next one is Force Manager. This is you can go to the next one. Next slide. Yeah, Force Manager is a sales CRM. It closed Series B, 12 million Series B end of 2017. and it has closed a Series A 3 years before. Today, we have the privilege to have the testimonial from first manager, CEO, and founder, Oscar Macià. That will be in a few minutes. We'll see his testimonial and valuable insights. So next. So what are the basics to be fundable in this time period? Right? You're running against the clock, so you need to do your homework during this time. The first one is that this journey is a milestone funding. So investors will not fund you all the way until you are break even or cash positive or exit. It will fund to reach, so you are able to reach the next stage of development. So you have to meet your milestones in order to be fundable. Right? We'll see in a while how we work on this. Then what are the valuation drivers that you need to focus on? First of all, you have to show consistent and strong and consistent revenue growth. You have to show that this growth is efficient, both from a sales perspective and also from a cash perspective. And you have to show good net revenue retention metrics. As a matter of fact, the net revenue retention is getting a lot of attention lately, and it's becoming like the key metric for SaaS, for recurring business. So you need to start measuring this metric. We'll also talk about this in a while. And about everything, all of these, cash is king. Right? So you have always to be aware of your cash reserves. You don't want to be in a position that you are run out of cash and you haven't reached your milestones, because then you're going to be in a very difficult position, very complicated to raise another round. So it might take you out of business. Or if you are able to raise another round, it may be under very punitive terms for entrepreneurs and the founding team. Next. So the 3 points that you need to focus in this journey to be fundable, again, is first of all, we need to set meaningful, we have to establish a meaningful set of key milestones. So what the milestones and the key performance metrics will depend on the stage of development you are in. We'll see that an example after. So not all the companies have the same milestones depending on the stage of development you're in. What you want to set is ambitious milestones that you can increase your valuation at the next round, at least double the valuation of the previous round. And then you have to make sure they have enough cash to get to the next stage, to meet these milestones, so you are able to fundraise at a good valuation. What are the key valuation levers? And these are consensus and some empirical studies, as you can see here, that establish that the key top 3 valuation levers or drivers are revenue growth, sales efficiency, measured typically as a CAC payback period, and net revenue retention. So those are the performance metrics that you need to focus to increase the valuation of your company, or to be fundable again. I mean, if you don't show revenue growth or your sales efficiency is low and your net revenue retention is poor, then you're going to have a difficult time raising another in the next round. And then the last point is you have to execute your business plan. A business plan that you have to align with investors has to be focused on achieving the key milestones, the meaningful milestones, and the valuation drivers, and also make use of your investors or advisors. Investors can provide much more than money, can provide good advice because they have a lot of experience with other companies that have gone through this. So at this point, I would like to ask Borja, how can investors help the companies and how the company should manage the relationship with their stockholders? So that is a love-hate relationship, no? So how do you, as your advice in this?
Yes, absolutely. This is a critical point. You're fundraising, not just for the money. You're fundraising also to get some smart people around you to help you in this journey. But once you have these smart people around you, or at least we hope that we can provide with some smart advice, you need to actually use them. You need to make sure that your investor becomes your trusted advisor. And for the advisor to perform properly, they need to be informed of what's happening in the company. So it's a kind of like what the consultants, the big strategic consultancies are doing for the listed companies. Well, you're doing this. The investors are usually either having a package of experience, or they have been consultants before, bankers, entrepreneurs, so they can definitely help. And you're paying for their services, allowing them to come into your cap table. But many entrepreneurs do not communicate with their investors very often, and when they talk to them, they only speak about the good things, and you paint a rose picture of what is happening with the business. And then suddenly there is an issue that you want to have their help with, or maybe there's a crisis or something, like COVID happens, you need to fire somebody, sales are not coming, there are losses bigger than expected. And you ask for the investors' help, but they don't know what's going on. They've been hearing all these nice things from you. So it's very hard for them to provide a good advice. Okay, so you need to trust your advisors, be open to them, because that is the best way for them to provide value advice to you, and it's the best, obviously, in their best interest as well. I mean, they want you to succeed. You're part of the same team when the investors come on board, and you need to make sure that you use them. At least, for example, in my case, at Nauta, we actually take a sizable portion of the cap table. That's part of our business, the way to deliver money back to our investors, our limited partners. In return, we not only give money to our portfolio companies, we hope to provide some sound advice. But it is true that I'm a person, I've got my limited time, limited bandwidth, and whoever, the entrepreneur that extracts more from me is that one who calls me often, who basically has a relationship with me, over WhatsApp, Zoom, calling, coffees in person, whatever the COVID allows. So basically, make sure that you actually extract the value that your investor can provide. Have a communication channel open with them and use it often. This is why we are investing in companies. It's not about the Excel, to decide whether this is a good company and we're going to make money. It's about, sharing your journey and maybe cheering you, obviously, from the base. You guys are the ones going up, as I said, going up the Everest and going onto your journey, and we are helping you from the base. But that's why we have investors, because we like doing this. We like sharing the pains, the ups and downs, the roller coaster of running a company, and we really, really hope to at the end of the journey that you can talk to us and say thank you, investor, because you actually helped me. That is even more than the money. That is what really makes us get up in the morning and go very happy to work.
Definitely. My experience is that investors provide money and many other things, but you can take advantage of that and get your connections with investors and have this relationship established. And so can we, yeah. So as we mentioned, the milestones that we need to achieve depend, and the performance metrics depend on the stage of development the company is in. This taken from Bessemer Venture Partners, a well-known SaaS investor, and what they are looking for at each of the very high level, at each of the stages. So basically, and it's probably is nothing new, but it's important to remember this: the Series Seed, the objective of Series Seed is to find the product market fit and sub initial market traction. The early stage or the Series A, the objective is to find the go-to-market fit and also a proven revenue model. And the growth stage of Series B and beyond, the objective is to scale the business. And scale meaning revenue growth and grow efficiently. The important takeaway here, and we see this many times, is that you cannot skip any of this. You cannot go to growth stage without going to a product market fit. I mean, you see companies hiring or building a sales team when they have not find the product market fit. Right? So you spend tons of cash building a sales machine when the sales machine is not product market fit or not product revenue model. I like a quote from an investor, Ella Gill, that says that too much post-product market fit advises even to pre-product market fit companies. So be aware of that, because we see this many times. Companies investing a lot. You need to, before you scale, you need to see what works. Don't scale too soon, because there's going to be a waste of money. You will not going to reach the milestones that you need to fundraise or to raise again, and you may put the company in a very, very complicated situation. Okay? And that's probably one of the causes why companies fail, right? They run out of cash because they spend cash in things that don't have a return, and then you don't achieve your milestones, and then you are not in a position to fundraise again. So again, it's kind of obvious, but we see the situation pretty often. And then we'll see that in the Oscar's Force Manager CEO testimonial. He talks about this also firsthand. Okay, we can go to the next one. Here in this ecosystem, we see some fundamental changes, both in the SaaS business models and also in the startup ecosystem in general. One is the SaaS is developing new business models, product-led growth, usage-based, consumption-based. And what we have is a sales metric playbook that helps to measure the performance of traditional, so to speak, SaaS companies. So some of these metrics are not good to measure performance of these new SaaS models. For instance, as an example, CAC payback is a measure of sales efficiency. Product-led growth companies don't invest in sales and marketing, they invest very little. So they have a very, very low sales and marketing expenses and very, very low CAC payback. So that's, in this case, that's not a good measure a good metric to measure the performance of this company. You need to use other metrics. No? So this being built, OpenView, Battery Ventures mentioned here are one of those, building more content and also creating this whole new playbook. No, but we still need a little more of time to come up with a solid metric playbook that help us to measure the performance of these new SaaS business models. A new PLG metric emerging is natural rate of growth. You see how much your company is growing based on your product, not based on sales channels like sales and paid channels like sales and marketing. So that's the natural rate of growth. You can find a lot of information in internet about this. It's hard. It's easy to say, hard to put in practice. It's kind of complex still. And so, but be aware of this. Depending on the company, we'll have to start defining new metrics that help us to understand how the company is doing and measure the performance.
By the way, Jordi, just to comment here, helping you create a KPI dashboard is part of the job of the board. It's part of the job of the investor. This is one of the questions that you can ask an investor for help with. And it's definitely a very important topic for the success of the business. The other day, I was talking to another investor who did this with one of their companies. And at the end of the journey, when the company was exited, the founder of this company that was exited said, look, not just that your help with the M&A was useful and actually created, the value or protected the value that we have created. The founder said, I think that the help that you gave us with a dashboard or metrics to guide the business is as valuable as M&A or anything else that you guys have done for me. We have been progressing the company, adapting the KPIs, and understanding the levers, understanding when there were issues, correcting the journey. So basically making sure that the metrics are correct, that they're followed, that they are discussed that was actually very, very useful for the founder and help the founder reach, exit.
Definitely, that's a very, very good point. And we also have metrics, and we also help the companies to establish these metrics dashboards and follow them and act on them. And then the other thing that's changing, it is a trend that is happening recently, is these preemptive rounds. So startups used to raise, no? Actually, this is a theme of the presentation. It raises every 18 to 24 months, but because of a lot of liquidity in the market, and a lot of so investors are proposing investment offers to startups, hot startups, even though they are not in the market raising capital. No, that's called preemptive rounds. And I would like to see, Borja, your opinion on this round, if that's something that you see often, and what would be your advice to the founders that receive this inbound interest from the investors?
Yes, it's a very appropriate comment because, as you say, there's so much liquidity in the market. Central banks have been giving money to everybody. They're looking for returns, and they have found some potential returns, also with a lot of risk in cryptocurrencies and venture capital. So suddenly, lots of private equity firms, lots of major investors are coming. Venture capital funds have a lot of money. They need to invest. And it's our job to not just wait for best deals. That's not how our work happens. We are going out there farming or hunting for deals. And it's part of the team, of my team, to call out and in an outbound manner potential opportunities. And you guys, basically the successful founder who just raised a round and got advertised on TechCrunch or other specific press, and you really don't need the money right now. Suddenly, you're getting all these flash of calls from investors because an associate or somebody in the team saw the article and they're calling you. Honestly, just be wary of being distracted by these inbound approaches. You are at the helm of the boat, of the ship, of the company. You guys need to understand that, hey, we've closed the round. We have money for the next 18, 24 months. We should be focused at least for 6 to 12 months on executing the plan that we have promised our investors. Okay, the investors just came on board. So be mindful that you shouldn't take the eyeball off the plan that you need to execute, because our job, I'm sorry, is to speak to you guys, find out whether you're a good opportunity, and to go in before somebody else is our competitor to go in. So this is our job when we're doing it, but it's not your job. You've already raised a round. Your job is to execute the plan. So be mindful of this. However, it is true that after a few months that you think that the company is going in the right direction, you have maybe enlarged the team, you have expanded to a new country, you're already like executing the plan beautifully. Investors will notice, and it's actually good for you guys to share this news of your progress with your investors. So every quarter, for example, you can send an email, a newsletter to a selected group of investors. So every quarter you tell them, look, this is what we've done. I promise I'm going to do this in this quarter. And then in the next email, you say, do you remember what we promised? Well, we've delivered. And after a few times, you're gaining their trust. So whenever you send in the email saying, oh, I'm now launching a round, the investors will be totally bought in already, and they will be very happy to participate. So it is true that you need to liaise with them, but always leading as a company co-founder and not just being led by the investors. However, this is true that now there's so much liquidity that there's extensions of series coming up. So I've raised a round 9 months ago, and the companies, investors are coming in and are calling me and they want to go in. And maybe they will be happy to chip in some money quickly. So this is important. Just a reduced amount of time that the CEO's bandwidth is focused on fundraising, because otherwise focusing on execution. If you think that with a certain number of investors, with a limited amount of time, you can raise extra money at a sizable up round, like for example 50% above the previous share price, or even more, even double, then obviously it may be worth taking this extension round and accept this new investor. Also, even more if that investor is going to be useful in terms of business, or maybe is going to be able to lead the next round, and they just want to put like a first check, to have a right of first refusal, if you will. But in any case, needs to be limited amount of time that the CEOs the CEO is focused on the team, on the company, and definitely demanding, if your company is going well, demanding a larger valuation. And obviously, that in VCs you have different people. For you to understand whether a VC is really honestly interested, or is just kind of wasting your time, ask at least in the second call to have a partner involved or somebody higher up. Okay, and that way that yes, if the partner is on board, definitely they're not wasting their time, they're interested. But be careful. Although, to be honest, we have seen in our portfolio companies and metrics clients that there are very nice extension rounds at a higher valuation that they're available out there.
Yes, totally. Okay, so before we move to the next section, which is executing the business plan, I would like to show present a testimonial from Oscar. Oscar is the founder, as we said, of Force Manager. He has built a successful company and has taken it across Series A, Series B. So he explains firsthand his experience scaling companies and the challenges he has faced. So it's a 7-minute video, so don't go away. What are the main differences between Series A and Series B? What do investors want to see in order to invest in each of these series?
Well, Series A, when you get in Series A, this is basically what I found when I was doing this crazy journey, right? When you get into Series A, most of the times investors, they are looking for initial traction, and they're looking for a validated market fit, right? At least validated initial market fit. And on Series A, when you're talking with investors, they are going to ask you for your growth metrics. They want to see growth, but probably they are not going to look at much at what's going to happen during Series B about the scalability of the sales machine, right? So you get into your Series A with a validated initial traction, but you have to go to Series B with a validated go-to-market fit. It means that you have to prove that you have the metrics, the right metrics, that will make the Series B investors multiply the value of their money when they invest in your company, because you will be able to transform those resources into growth. And for achieving that, you need to prove that you have the sales machine in place and you have the right metrics. What I mean with right metrics, I'm not talking only about sales. I'm talking about having a well-organized cohort analysis on the different cost of acquisition, churn. And of course, one thing that you have to take attention as well when you are transitioning between Series A and Series B is something that is extremely important, is customer success. Customer success is key when you are moving between Series A and Series B, because if you end up your investment period of your Series A and you didn't manage to get good retention metrics, then you're gonna get a really hard time getting your next investors, for sure.
Yeah, we'll talk during the presentation. The net retention rate is becoming the key SaaS metrics now. So we'll see this during the presentation, but it's good to see that you're experiencing that firsthand. Well, right after you close Series A, you have to go back to work. It's a good congratulations, but you don't have to waste a minute and start preparing the company to be in a position to be fundraise Series B. In this case, in your case, what were the main milestones that you needed to achieve to be fundable again?
Well, the most important one is to have the right metrics. Now you have to prove that you can really be a company that can go to the 100 million ARR, right? So you have to prove that you have everything in place. You have to prove that you have a scalable company. You have to prove that your product is going to scale, that your sales are going to scale, that the marketing that you're doing is scalable. So everything is about scalability, because as I was mentioning before, investors, they are going to invest a bunch of money, but they want this money to multiply the value, right? So for achieving that, it's not just iterating, and find a way to move forward. Is that they want to be very certain that you will be able to multiply those resources. So you have to be very clear on showing metrics that will tell them that you have a machine that can convert these new resources into growth. So you have very clear go-to-market fit and very clear market fit. I think that's probably the most important things. That's the reason I was putting a lot of attention into customer success and so on, because at that time, you start having customers that they've been with you like for several years, right? So you have to show that you can really build a scalable company that has strong fundamentals, right? That you can even be able to retain and upsell customers that have been with you for such a long time and so on. So it's like a different game, right?
Scalability, show that you can grow efficiently. Yeah,
absolutely. You have to, yeah, that's right. You have to show that you can keep growing efficiently, and it's something that can go to the next level.
Mm-hmm. Correct. What were the main challenges that you faced scaling the company?
Well, there are a lot.
Yeah, the main ones.
Well, if I had to name some of them, well, the first one is and it's something that happened almost to everyone, right? When you get founded, it can happen in your Series A or even your Series V, is to spend resources at your own pace, right? Your own pace, sorry. Why? Because most of the times you feel a lot of pressure from investors. You're like telling, okay, you have to hire this, you have to hire that, you have to go to this country, to the other. Don't do anything that you don't feel you are ready or you are prepared, because you know better than anyone your company and how the wheels of your company are moving and how everything is really assembled. And if you move faster because you have investors pressing you, probably it's going to be the recipe for disaster. This is number one, right? So take your time and invest on things that you are pretty sure that are going to scale. Because if the idea of one of your investors it's something that you don't agree with and you put this in motion, then you cannot complain, right? It's your responsibility, not their responsibility, right? So this is number one. Number two is it's about killing things. Entrepreneurs, we are very good, putting things in motion, start new projects, start new ventures, whatever. But we are really, really bad killing things, right? So what happens most of the times is that you start, with new initiatives because you want to grow your company and you want to test a lot of stuff, right? You want to test this market, you want to test this new channel with this new product, whatever. And if you don't kill things that don't work, then you end up with a very messy organization, very complex organization, and complexity is what you have to don't do for sure, right? Complexity kills companies more than cash, right? So you have to avoid complexity, and the only way to avoid complexity is killing things that don't work. And this is one thing that I learned the hard way, because if you don't do it, you end up with a messy organization, super complicated, and you cannot really keep moving forward, right? So this was number three, complexity, right? Avoid complexity at all levels, even at organizational level. And it goes to my fourth point is it's not easy to grow personally with your company, right? Because this is a very long journey and it's a complicated one, right? Not everyone can scale with the company. And it happens very often with managers, because the management team that you have, the leadership team that you have when you are at Series A, it's like heroic management team, they like put a lot of energy, they move forward, but when you get to Series B, you just don't need this kind of energy. This is a good energy for starting a business, but for scaling a business, you need another type of energy. And some people, they can transform themselves and they can learn, but some people, they cannot, right? And there is a big leap forward in terms of management is that when you have maybe 50 employees company, Most of the times your managers, your first line of managers, they are managing the teams directly, which is great. Maybe someone is super good managing teams directly, but it's not good managing other managers. So the big change here is that you need that your managers should be able to manage other managers. And this is not trivial. It needs a lot of coaching, and sometimes they cannot do it because they don't know and they don't learn, right? So you have to do this transition, and if you have to change pieces in your management team, you have to do it very fast, because if you don't do it, again, the same way I was speaking about killing things, right? You will end up with a messy organization, a very complex way to manage your company, and it's going to be another visit to the disaster.
Yeah, it's about having the right people at the right time, no?
Absolutely, 100%. And as I think, again, we have incredible people at the beginning with the energy, to move mountains. But sometimes when the company scales, you need other
type of management. Yeah, definitely. What entrepreneurs say is that people management is probably the most challenging issue when scaling a company. Is what you actually are also experiencing, no? Well, thanks a lot, Oscar, for your insights. Very valuable. You have a great experience, so I'm sure the audience will benefit from your insights. Thanks a lot. Based on your experience.
Thank you, Oscar, for your insights. So I'm just realizing that we are kind of running out of time, so I'm going to go very fast. Sorry, but you will have access to this presentation. No? So here about executing the business plan and touching on the point that Oscar mentioned is about the main challenge that the company is facing scaling, which is the people management. No? Bringing the right people in at the right time. So at this point, I would like to ask Borja, what's your view on if you agree with this, that you see a lot of companies and a lot of situations?
I totally agree with Oscar and anybody who says, obviously, people management is the most challenging part of scaling a company because people can't scale. It's very hard to get the right talent. It's very hard to train them, clone them. We cannot clone them yet. People are they don't change so easily their skills or their features, their characteristics. So when you are starting, as Oscar said, you have a type, maybe like 5-6 guys, a couple co-founders, maybe like one of the developers is a developer who likes coding. Then the company goes well, they raise money, and suddenly you're not 5 and you're 6 anymore. You're like 20, 25, and the developer who likes coding suddenly has 2-3 junior people who he has to train, and maybe he doesn't like training or she doesn't like training. He's not good at that. I mean, what are the chances that you're good at, very good at coding and very good at training? So that obviously becomes an issue for the lower level then, because they need to learn how to manage people, right? Then you have managers that early on know how to manage, maybe 1-2 people, act very quickly. They go straight to the point, and then you growing, and this company is no longer 20 people, it's 100 people, 200 people, and this manager needs to become a director. It's no longer about going straight to a problem and solving it. You need to basically prepare a strategy. What are the chances that somebody who's really good at executing is good at managing, and then maybe whoever is good at managing is good at strategizing, to be a director, to actually have managers underneath. Maybe they don't even like it. Maybe they're good at it, but actually you don't like it. And then the higher up level, you are a couple co-founders, 3 co-founders. You really want to innovate. You're good at cracking up, solutions for problems and talking to clients directly. Suddenly you are a 100 people company and you're leading this company. Your job is no longer coding or hiring, young people. Your job is different as a co-founder, as a CEO, as a C-level. Your job is, for example, for a CEO, job is a vision. To understand the vision, to explain the vision, both internally and externally, to have relationship with stakeholders that maybe you don't like. Maybe suddenly you say, I'm good at coding, but I'm not good at talking to investors, or maybe like super higher up governmental organizations, or to be an evangelist in some sort of forum or big conference that maybe you're not good about, you don't like it. And then the last thing that the CEO has to do is, and the most important thing is to basically attract the best talent and to retain it, to make the most of it. So basically people need to do different things at different stages of the company as the company grows. And maybe the people you had at the beginning on a specific role, later on, they are not the appropriate ones. So there's that management of to try and acquire the right person and maybe eventually say, thank you, you were with me from the beginning, but you should not be, for example, the chief management officer, chief marketing officer, because you were 5 people at the beginning and somebody, did marketing. So he was a CMO. And then later you realize that maybe that wasn't the right choice. And for the company's sake, your good colleague that has been with you since the beginning, has the title CMO, suddenly you need to be demoted or fired or has to go do something else, or maybe you need to recruit somebody on top. So that managing of people is really the most difficult thing of scaling a company, Charlie.
And this also applies to the CEO or founder, right? Sometimes the founder is not the right, it's more technical person, is not the right person. And not all founders are willing to step aside.
Absolutely. Honestly,
so,
for the sake of the company, you need to understand that sometimes the person who initiated a product and got the product market fit, maybe is not the appropriate one to raise, a $100 million round and lead 500 people, 500 people strong company. There are different challenges and different stages. More mature stages need more, fine tuning, focusing on efficiency. Maybe it's not that fun for some founders. Anyway, so this is difficulties that you need to be mindful of.
Okay. Next then. So yeah, I'll go very fast now because those are, when you get this presentation, you'll probably read and get the same as we speak now. So now we're more on the finance side of the business. We have to scale the finance also. We have to build a solid accounting and finance foundation because we need to prepare. The demands are going to increase a lot. The requirements for information from the stakeholders, so we have to be prepared for that. Here, what I show is that when we do our financial and business due diligence, these are the main issues we find. And then things that you need to address, and as soon as possible, because as you scale, you need to have all these financial infrastructure in place. These are related to revenue recognition issues. You need to build a management P&L, not the statutory accounts, but more in the vision of the management accounts. You have to move most likely from cash accounting to world accounting. You have to, and that's something that Borja mentioned before, that you have to calculate the metrics correctly. And here is a quote from ProfitWell. Almost 50% of SaaS companies don't calculate ARR correctly. Not everything is ARR, and not everything is recurring, although investors like the recurring, the ARR terminology. And finally, you have to invest in scalable financial systems, right? Tech stack and processes. Next, please. So scaling a finance, establish a solid finance and accounting foundation for us has four main, evolves about around four main elements. One is the build a data-driven finance operations. You need, there's a quote, that's not mine. If you can measure it, you cannot improve it. So you have to, you need to establish the metrics that you want to really matter, that you want to measure, and act on the results. Then you have to plan, both short-term and long-term. Short-term, the annual budget. Long-term, a more longer vision, 2-3 years financial plan. You need to keep track of how you're doing versus the plan. You have to update the plan, the volume forecasting, and you always have to keep an eye on the cash. You need to know at any time how much cash runway you have, how many months of cash left you have. It's gonna be critical. Third, and we mentioned, we need to build a financial infrastructure. That's, as you scale, things get complicated, a lot of transactions, you need to keep track of that. The basic operations, you need to establish sound systems, most important billing, metrics, accounting, and also establish the proper accounting policies, monthly closings, annual audit, staffing the finance department. As the whole organization is going to scale, it's going to go a level up, things are going to become more complex, and you need to scale also the whole financial back office operations. And finally, you need to establish a financial reporting. Some companies at early stages don't have this established, but you need to establish that's the way you're going to communicate with your investors, with your stakeholders, with the board, and also internally. The monthly quarterly financial decks, financial highlights, KPIs, how you're doing versus the KPIs that you establish, actual versus budget, the whole pack financial deck. Next. And something that's becoming very important is the whole segmentation and cohort analysis. I mean, this is nothing new, but this is something that's becoming more and more important, more with the new business models, SaaS business models. And this gives you so much valuable information that you can act on it and decide which channels, which industries, which geographies you invest. This is not easy. This, again, easier said than done. Establish this is not easy because, for instance, you want to see the CAC the segmentation of the CAC by channel. You need to allocate expenses, the sales and marketing expenses by channel or by industry or by geography. This is not easy task. It takes a lot of time. And so maybe you don't even reach that point, but it's okay. At least have a sense of what channels are more efficient, of what industries, what geographies, what size of customers. And if you establish a segmentation and cohort analysis, you're going to get a lot of valuable information and you will act on it and definitely invest in those more efficient and channels that you have, or channels or segments, sorry, more than customer segments. Okay, next. And the last point today is there was a four topic is you want to look for alternative, additional financing sources that will allow you to increase your runway and achieve your milestones. To supplement or to complement the round that just closed, or do you in between rounds? So there are different sources: bank debts, alternative funding, R&D public funding. Bank debt difficult because the companies are not bankable, but you can try and you can get something cheaper. The cheapest source of funding. The other funding is becoming very popular. All this revenue-based funding, or companies that fund your marketing budget. The companies that, in case you have monthly subscriptions, they advance the month upfront 1 year instead of getting negotiating with the customer for a discount. Moving from monthly to full year subscription, you can get this full revenue upfront. Working with these companies, Capchase is a company making a lot of noise lately, and then you have the venture debt. It's more traditional, more expensive. It has also an equity component. This percentage of the principal is going to be converted into capital at a lower valuation. And the R&D public funding, probably most of you, all of you will know, these have a lot of public entities, European entities, national governments, state governments that provide soft loans, grants to R&D activities. And this is the final. The final would be, we have 3 minutes, so I don't know if there are questions.
Jordi, one question, because some people ask, what's the level of debt that you could have? In some countries in Europe, VCs don't like debt in their companies, because the companies obviously don't have EBITDA, they can, pay debt with, you're actually burning money. So they may create issues later on. But also having some debt, obviously, is less dilutive. So what's your opinion? And then maybe I can give you.
See, we don't have to forget that you have to repay the debt. It's not for free. So sometimes it's forget. Yeah, I'll give you some concrete examples. For instance, we're talking with Riverside. This is a revenue-based financing. They provide the debt that they want, the maximum debt they want to see is 50% of your ARR adjusted by gross margin, right? So imagine the ARR is 5 million, you have a gross margin 80%, that would be 4 million, 50%, 2 million, right? So that would be like that. Other goes by MRR. So the very standard rule of thumb is 6 times your MRR, right? So if your MRR is 500,000, which would be 6 million ARR, right? So that would be like 3 million, 50% ARR. Basically the same, but the first one adjusted by the gross margin, right? So
I think obviously if you have a SaaS very high gross margin, it really is the same, something like the number revenue or gross margin is similar, gross profit. But to be honest, if you actually adjust it for gross margin, it'll be more exact of
actually it's the revenue that you have to pay your expenses, right? So the rest go to the cost of servicing. Yeah, so that's why I mentioned this, but I actually thought it was interesting. There is some benchmarks around, but in the case of this Riverside and Liquidity, and is the benchmarks they use specifically as the maximum left that they will take, they accept for a company.
Understood. Well, I mean, obviously, to accept some loan for the company usually needs to be approved by the investors, some sort of investor majority. So remember to communicate this with your investors to make sure that they're happy with it. Some investors will not be happy with it, depending on how the company goes. Some of them may. But this is part of the discussion about guiding a company. But obviously, you know, in a level that is very manageable, it could be an option to basically extend your runway, avoiding dilution.
Okay. So in the last two slides are the takeaways. I'm not going to read those. I mean, basically a summary of what we talk about. I mean, you probably can follow this and relate to the presentation.
We'll share a post with the takeaways, and in that post we will actually add the links to the presentation and to the video as well of this. Please obviously share with anybody that you think may be interested. And we have a couple of questions, and we still have a few minutes, so because we've been late. So if you don't mind, bear with us. Jordi, one question. In general, how long does it take for companies to basically prepare the reporting, to basically get ready to all these reporting workload, preparing the boards? Are there templates that you think of? Is there something ad hoc? You know, can you explain something?
Yeah, I mean, depends on the company. Some companies, depends on the situation, starting situation. If it's a very transactional, very, usage-based models, or more recurring SaaS, typical SaaS models, large enterprise customer segments or small segment customers. But and then there are templates. We use templates and metrics, and there are also platforms out there, a lot of information out there to build financial plans, metrics, dashboards, and also some platforms like Charmahul or others, Profitwell, or others that allow you to build these. But don't forget the garbage in, garbage out. So it's not the platform that you use, it's the information that you process and how you handle information and how accurate this information is. So that's for me the critical point. And you may have the best platform, but if the information that you provide to the platform or whatever is going to do the reporting is not accurate, is not solid, then the output is not good. So in general terms, it can take 2, 3, 4 months from nothing to establish a proper financial plan, metrics dashboard, and reporting. And that's typically the time. But again, you have to start sooner the better. I mean, that's something that you're gonna need. Yes or yes. Especially if you go to Series A or B, and Series C probably not so much. Series A depends on how hard your company is, but Series B definitely need to have proper metric dashboard, financial infrastructure in place, and that also gives investor comfort that you have a control on the business. No, it's not something that you have control, and then you know what your metrics are and you know what the situation is. Yeah, so I would say just to respond, say between 3 or 4 months should be a good time to enough time to build all these financial infrastructure, to speak.
Yeah, one thing I would like to add is that this is not just reporting. This is also to guide the company. This is very important. This is information, data that the board uses to discuss how to get the company moving forwards. So it's actually useful doing it, not just for the reporting. It's not reporting for reporting's sake. It's for the sake of the company's progress. And another thing I would like to say is that the CEO, as they grow, the team, they shouldn't be doing everything at the beginning. Obviously, you are like 3, 4, 5 people, and everybody's like doing all this. Everyone has fingers in lots of pies, and you need to be like having lots of hats. Honestly, as you grow, you need to focus, and it's very, very worth it to, at the very beginning, to hire a financial person that can help you with this. Could be external, like Metrics Partners. They obviously provide CFO as a service, services, which is great when you're a small company and maybe you don't need a full-time CFO or financial head of finance. You can just simply recruit somebody who is experienced with the startups. It's not the same to be a finance a role in a startup than having a finance role in a big company. So this is something that we usually tell our companies, company founders and the CEOs, please get the appropriate heads, appropriate profiles that fulfill these functions that the CEO may do at the very beginning. When you're just only 3 people, maybe the CEO is doing the invoicing. The CEO should not be doing the invoicing when they're a company of 20 and you have discussions with a big client, or maybe they shouldn't be like tinkering with Excel. When you were 3 people, of course, but when you're 15, 20, 25 people, please get the right person on board, or hire them, or externally or not, to help you, prepare this dashboard, the financial reporting, and then for you as a CEO to consume it. Okay, you have to look at everything, and these KPI dashboards are very, very important to you. But maybe you shouldn't be the one doing them, because maybe the best. And then second is takes time, at the very beginning to actually fine tune it. Just make sure that you have somebody on board to help you with this, like metric partners or maybe like hire full time if you're already a Series B company, or you are within 6 months of Series B, Series C. Obviously, you need somebody on board that the investors feel, a CFO that might be, for the future. I don't know. Just think about it. It's important.
It is important. And you will realize it at some point, and maybe later, maybe too late sometimes. Not too late, it's never too late, but probably you have wished you had done this before. This takes time. It's not something that you do one day.
Better late than never, but if it's too late, maybe it's going to be harder to clean up.
And it's also, Borja, you were saying, not only to satisfy the investors' requirements, also as information that you can act on, right? The company, right? Absolutely. If you do the segmentation, I was talking before, you get a lot of valuable information. You can see that you probably invest in customers that are not efficient, worth to invest, and then so it guides you, and that's very helpful.
This morning I was at a board meeting, and basically that was the point. Hey, we need to make sure that we understand our clients, client profiles, use cases, classify per account, size of account, countries of operation. This is very important for the co-founders, the C-level, to actually guide the company. Another question, Jordi, before we start leaving the webinar: how often do companies adjust their business plans and make reforecast? Is this something that usually happens? How do investors respond to these amendments?
Yeah, there are several different reforecastings. One more tactical, right? That when you have the closing each month, because you adjust your plan to the actual figures, and then you make some fine tuning. Because you know that maybe your plan says that you want to hire X person to this month, and it's going to be higher next month, right? So you want to adjust that, because that will have an impact on the cash, But then there's more fundamental changes when you see, because of COVID, for instance, that was the main one of the. We experienced this not, so that your plan is not valid anymore. So you need to do the replanning, because that's going to have an impact on your business decision, on your cash, and you have to take actions on postponing hirings or letting people go, or postponing some investment decisions. So you need to have that. When there are fundamental changes, or you see that you are missing the plan in a consistent way, and you will not cover this gap, definitely do that. At what point? Probably the board level. Board meetings take place every quarter, because there's a point where you have to present this to the board, or talk about this with the board, and make a plan that you align with the board, and it's something that's realistic. It's good to be ambitious, but don't be too aggressive or too ambitious, because you know that you're gonna meet that plan, and there's no point on setting objectives that you know that you're not going to reach. So I would say the point to do this main reforecasting would be at the board level, when you see there's something that has a significant impact in the company, and it has a significant impact on the revenue targets and in your cash position.
Okay, good. Well, we have finished our time for this session, and we would like to say farewell for this series. We have reached the end of this webinar series on how to master due diligence for startups. We have had 3 sessions focused on different aspects of the due diligence, organized chronologically, before DD, during DD, after DD. So we know the fundraising is a sales process. And we know that people buy from people they trust. So we need to gain the trust, and we have seen that Great DD is useful for this, to gain this trust. You should be prepared to plan and follow a rigorous process to keep your house tidy, communicate appropriately, as this is a human-to-human interaction. Remember that we are people after all, even though we may be investors as well. A due diligence will add value, or at least should add value to your business, and you should take it seriously. In turn, a due diligence well done will help you navigate towards your next round, towards the exit, towards profitability, you name it. You create optionality. This is very important. And all of this advice is common sense. But we all know that in the middle of the daily battle of running a startup, the common sense is sometimes hard to reach. We hope that these sessions can help you in your own future due diligence. We have the materials out there freely available to you guys. Please share them. We hope that you've enjoyed these sessions as much as we have. And I don't know, Jordi, do you have 1 second to say something? Just
to thank everyone to be today and also in the previous sessions. It's important. I mean, as you said, we have to get ready, not only because we have to fundable, but because we need to set up objectives and measure those and act on those. And it's important to establish the proper infrastructure as a guide, as a guidance. And if you have any questions that we couldn't address today, you have our email address here. Please feel free to reach out, and we'll be more than happy to address your questions or concerns at any time.
Absolutely. Please let us know your feedback via email, LinkedIn, or otherwise. We would like to obviously know your thoughts to improve for the next potential material that we might prepare in the future. And so thank you very much, and see you at your next due diligence. We hope that we are your next investors. Have a good day.
Thank you. Bye-bye.